Hello, hello, hello. Welcome, everybody. My name is Judah Hoover. This is the Build and Grow with Real Estate show. That guy right over there is Josh Weidman, and this is Brian Lochner. I'm a realtor. Josh is a hard money lender. Brian is a guy who operates a lot in real estate. And we are going to be talking about the 4 C's of credit today. And it was funny, as we were putting it together, I was also getting some notes and information from Brian about some recent developments that are actually happening in the credit market, real and live. There's a lot of people out there who read books that were published a decade ago or blog posts that were published 5 or 6 years ago. And what we try to do on this show is bring the most current, up-to-date information. And so I begged with Brian to please come on the show. And he's like, listen, I'm doing this, event in Florida, down in Tampa. And I was able to pull him aside for just 10 minutes here today to talk with us a little bit about what's going on in the note space right now. And so, Brian, go ahead. Tell us what's happening.
Hold on 1 second here. Brian, I had to mute you. I'm sorry. Like, this is real life. He's in the middle of an event right now. And, so go ahead. We got some background noise there.
Do we?
Happening. It's not that much. You're fine.
Okay. All right, cool. So, sorry about that. So let me kind of just jump straight into it. So basically, when the market shifted, what we saw was the banks all of a sudden they started to panic. Right, they go into risk mitigation mode, and so they start to pull back their money, and they say we're not going to loan to anybody for a little bit, or we'll loan to just specific people. And a perfect example of what we call a credit crunch is like Chase Bank, for example. In March, on Monday, they said you could get a mortgage if you have a 620 credit score, right? That's how it's been for a while. But then by Wednesday, it was 640, and by Friday, it was 700. And so what that means is anybody with a credit score between 620 and 699 is no longer qualified to get a mortgage, not because of your situation, but because of the bank's decision to mitigate the risk, right? And so what we want to look at is we want to look at some data that kind of paints the bigger picture so that we can better understand what is the opportunity that we have. So what we've got pulled up on the screen here is the Mortgage Bankers Association. What they're tracking is the mortgage credit availability. And the mortgage credit availability is basically who's qualified for a mortgage. Okay. And so as you would imagine, and if you hit the button, it'll show you this is on September 10th, as you see there. So this is the most recent article. They come out with stuff every single month with an update. But what I want to show you is that if you go to the graph, it will actually show you a sharp decrease in who actually can get qualified for a mortgage, right? How many people are getting qualified? And what you're really looking at here, what this picture is telling you is that there are 30%, at least 30% less qualified borrowers today than there were in January. So why do you care about that? Well, if you're a wholesaler, your buyers list, they're borrowing money from somewhere. And if they can't borrow money from there, whoever their source is, unless it's private money, then they're kind of going to be in a pretty tough spot, right? They can't buy. If they're rehabbing, right? Even some hard money lenders, right? Where I live in the Texas area, we've had several hard money lenders basically say, look, we're not doing 75% LTV anymore. We're doing 60% because we're scared. We don't know what we're doing, right? Yep. And so what does that mean? That means you, as a rehabber, got to have more money out of pocket to go do more deals. It totally screws up your scalability. Same thing if you're doing that burger strategy, right? You're buying it, you're renting it, you're buying it, rehabbing it, renting it, and renovating it. Refinancing it. Yeah. Right. Again, can you qualify for a mortgage, right? Just because you could in January and your situation hadn't changed, the banks are saying from their side of things, look, the thing has changed. So it's really impacting everybody. And what I want you to understand is this is the perfect sign of, look, when 30% of the market gets taken away as far as mortgages go, what does that mean? That means creative financing will fill that gap because people still need to buy houses. People still need to borrow money. And if you'll learn the creative financing side of things, there is a huge opportunity to market to these people and work with these people who have a 690 credit score, who were really qualified just 6 and 8 months ago. And so it really reduces our risk. And so now not only is there a bigger opportunity, there's more of these what we call penalty box buyers than ever before. They're also more qualified than ever before, again, reducing my exposure, my risk. And so the opportunity is better and my risk is lower. And so it's great. And so the second kind of piece of this that that people really look at is they say, well, yeah, but COVID, people are shy with their money right now. And it's really a misunderstanding of what's happening, because the mentality in a lot of the investors right now is, well, if I own or finance, I'm going to have to take like, $5,000 down on a $200,000 house. And like that's not a lot of skin in the game, right? I mean, normally when we're, as investors especially, we want big down payments, we want high interest rates and stuff like that. And so if you go to the next slide, what you're going to see is this is a study that was done.
Oh yeah, there we go. Okay. One more, right? Here we go.
Yeah, and maybe even one more, I think, because there's two of them. What this is showing you is this was some information that came out that shows you the buyers from 2015 to 2019, what was the average down payment, right? And then you looked at just that same group, but just people who bought houses in March, April, May. So during the pandemic, during COVID, what's happening? And really what you see is, look at the bottom left, 20 to 29% down. Okay, that number really jumped up. Look at 30 to 40%, 40 to 50%. So what I'm trying to tell you is the combination of these two charts is telling you that the opportunity for creative financing to create your own notes and play the role of the bank is bigger than ever before. The quality of person is not subprime borrowers. It's not subprime, all that stuff. It's quality. Plus, now you're also, not just from a risk mitigation over here, I'm getting a better borrower, I'm also getting somebody who's putting a lot of skin in the game. Because the people that we're targeting that we call penalty box buyers, these are typically like the avatar of someone who has decent credit, who has a lot of money in the bank. The number one thing when someone gets shut down, when they're told, hey, you can't get a mortgage, the number one thing is they're told you got to have at least 20%. So what do? They start working on it, right? I'm going to start saving my money up. If it's their credit, they can fix their credit in 6 months or less a lot of times. But down payment, that's going to take some time. And so this huge pool of people have been working on this 20% thing for years and years. And now that they're ready to pull the trigger and do something, we're in the middle of a pandemic and they can't. And so again, it's just when anytime we're looking at doing deals, we care about what do we get and what happens if things go wrong. In this case, we're getting, obviously an asset that we're going to resell to someone who's going to lower our risk if something goes wrong, right? Because they're more qualified credit-wise, payment history-wise, and then also they're going to have a bigger down payment. And anytime we're creating a note or just buying a note, the main question we're asking ourselves is, what's the likelihood this person's going to pay? And when someone puts down 20, 30, 40% on an asset, they're going to pay, right?
Well, what do you think? What do you think the reasoning behind this is from the lender's perspective of why
are lenders pulling back?
Right. Thank you.
Okay. So as you would imagine, lenders are really preparing for something. Anytime there's a shift in the market, creative financing takes over because the banks pull back. And the banks pull back because the last thing they want to do is be lending, and then have all this default happen, right? Because they were too loose with their lending. Think about 2006, 7, 8. What happened? Lending was too loose. And so there had to be this massive credit crunch. We don't lend to people right now because they're nervous, right? Not to mention they got shareholders, I'm sure, that are writing them letters and things like that. And so it's really more a matter of, loss prevention almost. If you go look at what the Fed is publishing, and I'll have to find an article on this, but they're saying that banks are really basically stacking up their cash right now to prepare for the losses that are coming, because they just know it's inevitable. Because really we're in this mortgage meltdown in slow motion, right? It's happening slowly. And the banks are preparing for it. And that's just one more indicator for us. When the banks are like, oh man, let's stack up our cash so that we can make sure we're protected. What is that telling us? That tells us, okay, there's an opportunity that's here, and there's an opportunity that's gonna be there for a little bit.
So banks are holding on to money instead of lending it.
Yep.
And that this is one of those things where people, I remember during the Clinton years and stuff like that, people talked about talking down the economy, and I half wonder, the banks hoarding money, how much that could be a self-fulfilling prophecy, that because they stop lending, it actually kind of sparks the mortgage meltdown that they're worried about happening to begin with.
Yeah, absolutely. I mean, you got to think about how the banks really operate. The banks are incentivized to loan to less people so that they can go to the Fed and say, hey, we need to borrow more money and we need to borrow cheaper money. So the banks have the leverage essentially to crash the economy if they wanted to. Now, they're not going to necessarily crash the economy, but again, they're playing the game. The more money they can get that's cheap that they can loan out, it just makes them more profitable. And so again, we want to look at what the banks are doing. And when the banks, they make decisions, we have to ask ourselves, what does that mean for us as investors? And over the years, we've always just looked at it from the standpoint of, oh, I could just borrow cheaper money. Right now, money is so cheap if you can get money. But the bigger picture is on the other side, who can't get money? And we think of the subprime people, we think of people with no money to put down, but the reality is there's people out there with great credit scores, well, great being 620 to 699. That's a very qualified number, right? And then now you're telling me, even if it's on the lower side, even if it was 580, if you tell me you're going to put 40% down, I don't care so much about your 580 anymore, do I? Right? And so it's just thinking through that lens.
Well, yeah, I think the other thing that happens is there's less kind of those subprime lenders out there that are chasing people. And so there's people who I have a good friend of mine. He still gets people done all day, every day with 580 credit scores. He's a mortgage broker. And he knows, on that last slide, it talked about all regs, he knows how to read the regulations, how to package the file, how to actually get it done. He rolls up his sleeves and he gets these hard and difficult deals done. But there's like 0.1% of subprime lenders out there versus what there used to be. And so there's a lot of really good people who go into their credit union and they get turned down by their credit union. They go into their bank and they get turned down because their bank has a minimum credit score or a minimum down payment requirement that maybe other banks don't have quite as stringent that week. And so there's a lot of people who maybe could be or would be qualified at other banks, but they have kind of self-penalty boxed themselves, right? I mean, you like that term, penalty box buyers. I think there's a lot of people in the penalty box who are self-imposed. And at the end of the day, Brian, you don't care why they're in the penalty box. They're just there. You know what I mean? And once you create a note with them, and once they've made 2 to 3 to 4 years of payments on that note, and then they're qualified to refinance or take it out, you can kind of help shepherd them through that process too.
And the faster they do it, the higher the rate of return for me.
Right.
So again, it's all a very cohesive thing. And I go more into this on the Saturday when we go into golden notes and I talk about, who these penalty box buyers are, why it's so important. It's over $1 trillion marketplace, $1 trillion marketplace with a T.
Not a B, with a T. No, that's crazy.
That's right. We're talking about millions and millions of people who are in this space that they're all among us. They're all around us. And a lot of us are penalty box buyers. If you've been in business for 1.5 years, you're self-employed, and that's the only income, you probably can't qualify for a mortgage right now. You're a penalty box buyer.
Well, listen, Josh, Brian, we're going to let you get back to everything that you're doing. If you want to learn more about this, noteschool.com/BGRES, Build and Grow with Real Estate Show. There's a lot of other events, as you can see, that Brian does day in and day out. And usually people are charging their members to go to this event. Ours are able to go for free, and because we want everybody there. It's going to go from 9 a.m. to 3:30 p.m. There's going to be so much content that we're packing in here. You want to get registered. I was talking with numbers the other day, and Brian said that it's very rare that this many people from a group like ours have registered as early as they have. So we really think that this is going to be something that's going to sell out, and you definitely want to get registered for right now, sooner rather than later. Thanks, Brian, and we'll have you on again soon.
Thanks, Brian.
Thanks, guys.
See you, man. Awesome. I mean, all right. Well, that's good. That's good to hear. I mean, look, whoops. Holy mackerel.
That was me. I'm bringing it up. We're moving forward. We're rocking and rolling.
Horses, for crying out loud. What I wanted to say is I think it's really cool talking to Brian about specifically like some changes in liquidity. I mean, I've seen this across the board. We talked about this before, from, lenders that were essentially other hard money lenders that were lending 100% of the acquisition construction costs on a project, and sometimes up to 80% of the after repair value, now have retracted, and they need higher credit scores, larger down payments, much lower ARV percentages. And it's just interesting. You see that on a hard money side, or at least I do fairly frequently. But to hear about that in the consumer market, you don't hear a lot about that. What we hear,
right, that was really interesting, that percentage of down payments, and how you could see, like, the shift has really been away from people putting 0% down or 5% down to putting down up to 20% down or more. But the other thing is, and we didn't even talk about this, the perception is there's a lot more cash buyers right now than what there was a year ago or so. If you look at that percentages, those were very similar for over 50% down. Basically, if you're putting 50% or more down, you're putting 100% down, you're a cash buyer. So a lot of those percentages basically stayed the same.
That's right. That's right. All right. So today we are digging into lender analysis, the 4 C's of credit. This is something that we considered covering yesterday instead of, and kind of flip-flopping days. But since we're having Brian on, I thought it better fit our timeline. So, it's interesting how the 4 C's carry all the way across the board. And, I'm going to talk about this from a hard money lender's perspective, but this carries with retail loans. It carries with, car loans, like everything all across the board. It's pretty straightforward and pretty much the same. So let's dig in, right? Okay. So the 4 C's here, and it's funny, we talked about actually a 5th C. We should have a 5th C here, and I don't have it. Man, I feel unprepared. Now I realize we don't have it. The 5th C is character, right? Yeah. So, I mean, typically the 4 C's, we got collateral, capacity, capital, and credit. But let's add a 5th C and say character. And frankly, while we're on the slide, Judah, I'm going to let you take it away, because this one is a big one, the character.
Yeah, so I think character is really important. So character is in the commercial, character is never talked about in the residential world anymore. In consumer lending, it's hard to judge, it's hard to quantify, it's hard to use. And a lot of people who are 60 or older miss the days when you could go to your local community bank, say, I'm looking to buy a car, and they were like, oh, well, I don't need to see your pay stubs or W-2s. I know you own that ranch, you've owned it for a while, and you've done your banking here for forever, so we're just going to do this. So character was kind of overweighted in the past, right? And now we've moved to a point where in the consumer world, for your residential mortgages, your car loans, your credit cards, and things like that, it almost doesn't exist, because when they were trying to weed out a lot of those nebulous things that would make somebody either qualified or non-qualified for a loan, it looked a lot like racism, sexism, bigoted, homophobia, all of those things was kind of caught up in this character thing. So we've done away with it.
Well, on that note, you think about it. People typically hang out with people that they're similar to. People like themselves, just in general. Well, you got this dude who plays golf with Jim, who owns a hardware store downtown, and Jim wants to go buy a car. So he goes to the bank manager who he plays golf with and says, hey, Jim, I need a loan for a car. Well, right. They belong to the same country clubs. They go to the same church, and they know each other. He knows what he's doing. And so he gives him a loan. He's not even looking into all the other stuff.
Right.
Now you got a whole group of people that the bank manager doesn't play golf with, that might have different interests, might have different backgrounds, and all of a sudden, it's like, well, why aren't you giving the same loan to these guys?
It's like, well, I don't know him. The bank manager is used to giving loans based on who he knows in his gut, not necessarily looking at income. And so you would have people who had a different ethnic makeup, maybe made more money, maybe had better credit, maybe had more money in the bank, but because the bank manager didn't know them, they didn't actually get the loan. And so I think a lot of that stuff looked like racism when it actually wasn't, but that's a whole other story for a different conversation. It's just they weren't known. So we've taken out does the bank know you, and it's all 100% computerized now. But in the commercial world, With hard money, it still is with going to your bank for a refinance on your LLC loans and things like that. It still very much is character. And so character has a whole lot that factors into it. What's your experience like? How do you put together your package? How do you stack your loan thing? Do you talk about the good things and the bad things of the do you talk about the good things and the bad things of the loan? Whenever here's a deadly little secret. You ready for a breadcrumb that we put out there? Here's a little bread. Whenever I was getting hard to do loans done for people, and I would get them done at local community banks, I would say, hey, Josh, my friend Bayshore here wants a loan. He had a bankruptcy 5 years ago. I know you're really worried about bankruptcies within 3 years, but really even out to 7, you're a little bit worried. So he's got a bankruptcy 5 years ago, but he's got this much extra money in the bank. Or, hey, I know you only like it, if the debt coverage ratio is this, it's a little bit below that, but it's an asset class that you're really looking to do more of. So lead with the negative is actually a part of building your character. It shows that you're not afraid of. Tell the lender why they shouldn't do the loan and then back it up with all the reasons they should. So that is character, the 5th C that we're not talking about here.
There we go. All right. So let's jump in here to the 4 C's that you'll see that are pretty easy to analyze, right? The first one's collateral. That's pretty simple. If you don't know what collateral is, it's the asset or assets pledged to secure the loan. If you default on the loan, the lender is going to take that asset. It secures what they're worth. What's Taz saying? My bank won't give me a loan? Holy mackerel. Unbelievable, Taz. Go give them heck.
Right.
All right. So think about the asset in a couple different ways, right? First and foremost, if you're talking about a typical bank or typical lender, they're going to look at what the property is worth right now or what you're paying for it. If on a residential
appraised value or purchase price, whichever is lower for the first year after purchase.
That's right.
It's standard.
Exactly. If you're dealing with a hard money lender or a private lender or, even on a construction loan, they might look at things a little bit differently. They're going to take into consideration what's the current value of this property, what is the after repair value, but they're also going to look at some different types of analysis that are going to at least color the asset. And that is, if I have to sell this thing in 30 days, what's the price, right? If this guy falls off the face of the earth or gets beamed up into a spaceship and I got to take it back, what's it worth? Secondly, if I got 90 days to sell it, that's pretty much what somebody's going to look at when they're saying, okay, what's the retail value, right? And then last but not least, fire sale. Because look, if you've ever gone through a situation where, if you went through 2008, there were times when people were like, look, we got to get this off our books today because we don't know what it's going to be worth tomorrow. And so I know, at least on my side, when I am evaluating an asset, I'm looking at all four or five of these things. What can I assume the property is worth now? What's it going to be worth when it's done? What is the 30-day, 90-day, and fire sale price? The next C is capacity. This goes completely to the borrower. What is their capacity in a number of different ways? What's their ability to perform? Can they afford the payment? Do they have the ability to and the competence to oversee a construction project like this one? Have they done it before successfully, right? And a lot of this goes to character. Like there's a lot of character items that go into the capacity. And you might even consider like, hey, this guy has 5 projects going on right now. 2 of them are behind schedule. If I add a 6th project by funding this thing, is the capacity going to change? What's going to happen?
Right. This is so typically people think about your middle bullet point here when they talk about capacity, which is just ability to make the payments. Do they have enough income? And what's interesting is when you're talking to a commercial lender, they're going to factor more things into that. How many projects do they have going on? How experienced are they? There's There's people in your pipeline right now, Josh, who if they were working on 3 loans, you would still approve them. There's people who, even if they were just working on one loan other than one you're working on, you might not, approve them. So what else they have going on is very important. The other thing that I want to point out here is this is why lenders will sometimes talk about a global debt coverage ratio or a global debt to income ratio. So there's the property specific cash flow, but then there's also the global cash flow for the whole borrower as well. Meaning, if this property gets in trouble, if they can't rent it out for $1,000, if they can only rent it out for $800, do they have enough other income coming in?
Yeah, I mean that's a big one. That's a really big one that a lot of people overlook. I mean, I'll tell you right now, I'm dealing with a borrower that we got a loan that we're trying to close on Friday. The guy has a ton of real estate. He has cash in the bank. He's got phenomenal credit, but he also has 5 new construction projects open, trying to buy 2 more projects in the next month, and a lot of balls in the air. So like having $1 million in the bank is great unless your liabilities for the next month are $2 million. That's a problem. You got to look at all of that stuff. All right. The next C is capital. Like everybody knows what this is, right? It's your cash in the bank.
Here's the one little tip that I'm going to give everybody on this. Banks love seeing capital. Banks love seeing money in the bank. I've already told people, hey, you've got this $100,000 line of credit that's open and isn't being used, or you have like 30,000, used on it. So you've got like 70. Pull out another $30,000 and just stick it in a savings account.
That's right. So
it actually, it's dumb. It doesn't make sense, but bankers are people too, and sometimes they don't make sense. And just having cash sitting there, what you're telling the bank is, I have the ability to have money in my hands and not go buy a ski-doo watercraft.
Right. So listen, there are 2 pieces to this puzzle, right? The first one is cash on hand, and that includes just resources that you can tap. So if you've got money in the bank, if something goes wrong, you can step up and take care of it. If you don't, and something goes wrong, which often happens, who's going to pick up the ball, right? The other side of this is actual skin in the game. The skin in the game is an important part for a lender, because if you're putting in 20 or 30% of the value of that property or the cost of the project, the likelihood of you saying, the value of the property went down, I'm not going to finish it and walk away, is very low, because you're at least going to want to get your money back, right? So this capital can be in the form, in a number of different forms. Sometimes it's a line of credit. Sometimes it's cash on hand. Sometimes it's credit. Sometimes it's cross collateral on another property. I mean, Judah was talking about, just upping that comfort level of skin in the game by putting a second lien on a property with additional equity, just to have some comfort level of, hey, look, we're going to tie this up in a worst case scenario, hoping that doesn't happen. I think that's an important.
Yeah, the bank doesn't want that other property. What you're just telling the bank is, I'm really committed to you guys.
Yeah, exactly. All right. Last but not least here,
Josh, phone's blowing up.
I know. Listen, I'm sorry. It's the end of the month. It's the last day of the month. Everybody wants to close, right? All right. So credit is obvious. Everybody knows what credit is, right? Here's the thing about credit. It's not always a perfect indicator. And so it's the last one on my list here. If you have capital, if you have a great asset, if you have a high ability to perform, credit is not going to be that important. Holy mackerel, man.
Landline.
Kinds of problems.
Somebody from 1997 is calling you, Josh.
Dude,
answer it.
Yeah, my landline is blowing up.
Tell them the Phillies are going to be really good for a couple years and then go way downhill.
I love that. Okay. So here's the thing about credit. It gives you a pretty good indicator of whether or not somebody's going to be able to pay not either whether they're going to, whether they have the ability or not to pay that money back. So if you see, if a lender sees, oh man, you just had a bunch of missed payments in the last 3 months and you want a loan, the likelihood is, hey, you're probably going through some tough times.
Right.
You can also see, though, from a credit profile, not just necessarily a score, is you can see, oh man, look, a year and a half ago, this guy lost his job and he missed a couple payments, but he caught everything up. It went from 90 days late to 0 days late. And since then, he's right on track. Well, now you have a conversation about, hey, I see your credit score is 620 here or 600. What happened here? Oh, I lost my job. We went, did this and did that. I brought everything current. Everything's cool. But it's important. If you've got, if you're missing payments, it's going to make it really difficult to get a loan. That's it. Yeah. So, I mean, those are the 4/5 C's of credit. We're rounding out our education for the week. This week, tomorrow, we're going to have on Chris Haddon, who we're going to talk about varying ways of looking at an investment property and tagging a value onto that property. And then on Friday, we'll be back here with the news. But yeah, I mean, that's all I got for today. What do you got, Judah? Anything
Nothing,
good?
man. Great content. If anybody's interested in this slide deck, because we blew through it really quickly, just text or email Josh or myself. We will definitely get that out there to you. We love hearing from people. Let us know what we need to talk more about. Let us know what we need to talk less about. And we will be back here at noon tomorrow with more great content. See you, everybody.
Yeah. If you enjoyed the show, don't forget to share and like us, and we'll be back here tomorrow. Thanks, guys. Take care.
Bye.